Okay, the next thing we're going to talk about are some of the key economic terms and conditions. And we're going to talk about it both in the context of co-founders, assuming there are more than one founder, and also in terms of current and prospective future investors. It's fairly standard practice in tech startups, at least, to have something called reverse vesting on founder stock. And the reason for this is, let's assume that you've got maybe 3 or even 4, sometimes you see co-founders, and they say, oh yeah, we're super excited, we're gonna build this business together. Realistically, entrepreneurship's hard and it takes time to achieve the dream. So let's just assume that if everybody's fully committed and you're executing your plan, you know, it's gonna take 4 to 5 years, 3, 4, 5 years, really before you get this thing really humming. And let's assume that because everybody's like, oh yeah, we'll just do it even Steven. So let's assume you got 4 co-founders, each of whom has 25% interest. And then, you know, it turns out after 9 months that it's hard and the company's still pre-revenue and it doesn't pay very well. And somebody's spouse, for whatever reason, gets offered a job overseas and it's a great deal. The opportunity cost is too great. And this co-founder says, love the deal, love you guys and everything, but hey, I gotta move. That's fine. You know, this isn't indentured servitude. But it's also not fair to the other co-founders that founder gets to hold on to all of the equity, maybe some. So the concept of a reverse vesting is that we're talking about sweat equity here. And you don't earn it on day one for a penny a share. You earn it because you've been there on the journey, scaling the mountain, helping achieve the dream. If you leave early, then the rest of the team has to recruit somebody else. How are they going to do it? They're probably going to have to give them an equity interest. So this reverse vesting is actually a contract that helps the co-founders hold each other accountable. The outside investors, if you get, for example, sophisticated seed or VC, they like it too because they want to make sure that everybody's really committed. The worst thing that can happen is that somebody has a whole bunch of founder stock and then they run off and maybe they do it again with another venture. Meanwhile, people who are building it with capital and sweat are you essentially have a free rider problem. So that's the first thing and getting it right is really important, and sticking within the norms and starting from day one is, I think, important for reasons that I'll get into later, because sometimes if you don't put that in place, it's hard to restructure the company so that everybody feels like it's equitable, and it's also something that could be imposed upon you at a later date and maybe on slightly more onerous terms. All right, so that's one thing about economic control. Okay, there's a few other features that if you're doing a seed stage financing with Series Seed or more complicated, say preferred or convertible preferred, there are some features that have economic consequences. One is called anti-dilution. And so let's assume that you say to the investor, yeah, our pre-money value is 10 million or 20 million. And then later, it turns out that you can't raise new capital at a price that's equal to the former price, and you have to do what's called a down round. Is it fair that the other investors at an earlier date basically overpaid? You could say, hey, that's the way the cookie crumbles, but it is fairly common in preferred stock and venture financing that there's an anti-dilution feature. It's usually broad-based weighted average. It's not a huge thing, but you should be aware that it does effectively change the economics a little bit. Another one is, liquidation preference. We mentioned this before. With preferred stock, the preferred stock gets paid out first in connection with a liquidity event. And that preferred stock can be, participating preferred, which means essentially first you get the liquidation preference, then you convert and get your pro rata percentage. That can be capped, capped participating preferred says, yeah, they get that until they get a 3x return or something like that. It's an important thing because if you look at the capital structure of a company, there's something called a waterfall, which is in connection with the liquidity event. How does the money get distributed? And a lot of times there's 3, 4, 5 different classes, including outside creditors, employees. Obviously, you got to pay your taxes. But after all that's paid, then among the equity holders, who gets the money first? Now, in a big win, let's assume that this was a monster success. Nobody cares about this stuff because everybody's so happy. In a deal where maybe it's not such a win, it can be a big deal. And you as a founder might be saying, hey, that's not fair. We're the ones who worked for 5 years or 10 years. The investors also, they're making a bet, they're making a bargain. So let's assume, we switch courses. Let's assume that you raised $2 million at a $10 million pre, and then you later sold the company for $5 million. Okay, that's not a big win for the investor. So it probably is fair that the investor gets the $2 million back first, because first of all, there's no return on investment on that. And then the remaining proceeds can be shared. Because if you don't do that, you could have a situation where the founders actually do really well and the investor takes a beating. So that's why these things are structured. It's to align everybody's interest towards, taking the money and creating value, adding value. And when that happens, you get to share in that. And when it doesn't happen, nobody's happy. But the question is, who loses the most? And that's what these economic terms are about. Okay, there's another thing. We talked about how reverse vesting is a way for the co-founders to hold themselves accountable. And as I mentioned, the investors like it too, because it keeps people motivated to stick around to do the hard work. Pay to play is another feature that really works among the investors. So if there are these attractive features, the preferred stock features, for example, and then at a later date there's a financing, and not everyone either wants to or is capable of participating in that financing, then pay to play says, look, unless you pay, we're going to strip those rights and privileges that you had in the preferred. And so it kind of penalizes people for quitting. Now, this is an interesting thing because it may be that, for example, you've raised money from people that aren't deep-pocketed in the early rounds, and then later, you become Uber or something, and these financing rounds are at a massive valuation with huge sums of money, and frankly, you don't have the resources to play at that level. Is it fair that you're going to get washed out? I don't know, but it really it's another way for the investors to kind of keep each other honest and hold people accountable. Another way to think about pay to play is like poker, to be honest, in the sense that if you're in a poker game and somebody else at the table has a lot more money and you don't, that other person at the table can place a huge bet that you don't have the resources to match. And sometimes in the venture finance area, you've got these earlier stage investors like angels or maybe seed stage funds. They just don't have the money to put on the table. And the later stage guys, the big guys, can say, this is the deal, pay to play, you in or out. And in that circumstance, it does seem kind of unfair because what happens is essentially you get your preferred converted into common or something like that, or you lose certain rights and privileges. So it is what it is. It's how the big boys play. That's pay to play.